All right, we have reset the stream. Let me know if you guys can hear me. Kind of amateur hour over here in the tech department at Hourglass Trader. We are gonna keep going under the assumption that this is working now, so that there's not too much dead air on what we're posting here for those who are watching the replay. And I think it's working a little bit better. Awesome. People can hear me. I think the stream is working. We are going to keep moving. Point I was making before we had to reset everything is that, Corsair, we've got this play right here. We rolled our call strikes down from 35 down to 32.5, which, we were able to get a 31-cent credit, which means that our break-even price on that trade overall was decreased by 31 cents. So we're now in a position where if Corsair trades completely flat between now and Friday, we are in a situation where we are going to make a profit as opposed to be, just barely breaking even as what would previously be the case. And, the exchange for that, as we were mentioning, is we're going to have to sell the stock at 32.5 instead of 35 if it runs back up. But even if it runs back up past 32.5, the amount of profit we're going to pull from that is still a very, very nice number. So that is what's going on with the CRSR. Moving forward, though, if we do want to continue with this trade, what we can see right here is there's a really nice amount of premium for the August options, right? So we could set up that home run play again. If we want to, get something at 40, we'll be able to lower our break-even price by 80 cents, which gets us down to about, 30.50, which is a really nice reduction in break-even price, and gives us even more upside now into 40. So because they have earnings coming up, you're able to sell some far out of the money calls, and you're going to be able to get some decent premiums for this. So we're probably going to look to do something like that. I like the idea of, potentially having a trade in there where if this thing blasts off, we catch a good break and it goes to 40, we're sitting on a really, really nice return. So I think that's something that we're going to try to set up at the end of this week. But again, that's going to come at the end of this week. Closing the loop on the recap that we had for the prior week, our SPX hedge worked out really nicely as we were talking about last week. The RSI on SPY was looking ridiculous, and we could pull that chart back up really quickly. This is the go down to the R for, and I think just the whole computer I'm working on just dragging behind a little bit tonight. But RSI got super elevated. This is a little bit more of a time wider of a time frame. We know that 180-day RSI last time we talked was getting super elevated, and as is tradition, right, when this RSI, this indicator of relative strength, gets above 70, you could expect a little bit of a pullback, and that's exactly what we saw. We actually saw a pretty big pullback, and then quite frankly an unbelievable recovery, right? We pulled back from 434 down to about 428 at the base on July 8th, Thursday morning of last week. And then, like nothing ever happened, we're able Friday afternoon to be closing again at all-time highs, which is just unbelievable strength in the market. Makes me think we might be pushing 440 sometime soon. So I don't want to get too far in the way of this thing, but while I will always be the person who says, I think we're probably going to see some sort of decent-sized pullback in the near future, I don't really want to be in the business of trying to guess when exactly that's going to be. So if we go back to our recap really quickly, I always say I'm going to do this quickly, and I get dragged into continuing to talk about it. The one last point I want to make about last week, well, quickly a couple points. We know that the week of June 27th was not a good week for us. We go to the year-to-date summary chart. We have a little bit of a pullback, right? I mean, we've seen bigger pullbacks this year. We've definitely got ourselves in some positions where we were a little bit over leveraged, and we had some huge red weeks. So, in the scheme of things, what happened a couple weeks ago is not that bad. But, what's really important that I want to emphasize is we're going to keep doing what got us here, right? We're not going to be going for these home runs to get this $7,000 loss back in 1 week, because that is where you start running into trouble and maybe losing even more money on top of that. And that's not a position that we're going to want to find ourselves in, right? So we're going to keep aiming for 2, 3, 4,000 a week, which is, 1, 2, 3% of our portfolio. Keep pushing with those numbers. And, as we point out every single week when we look at these charts, the general trend of this account balance and the general trend of our performance is going to be up and to the right, because really we're just playing a numbers game where if we're consistent, patient, and continually making smart plays, we're going to be coming out on top. And that's exactly what we've demonstrated, and that's why we're not too worried whenever we have a losing week, because we have confidence that based on our historical results, the analysis we do every week, we're going to be able to make it back. And that's exactly our plan, why we're happy that we're able to, get $3,000 back. Not great that we weren't able to get the whole thing back, but getting $3,000 is the first step to getting that full $7,000 back. And hopefully next week we can get even closer to breaking even from performance that week. J Mart's in the YouTube chat. How's it going? And again, if you guys can hear me, feel free to let me know in the chat. I feel like we restarted the whole thing, and I don't know. At least on the Twitch side, I can tell from my phone that it's working again. I'm not sure how YouTube handled it, but if J Mart's, if you're checking into the YouTube chat, hopefully that means it's working out okay. So everything. Like we mentioned, small gains getting back, this decent sized loss. The only other thing that I want to emphasize that we did last week that I thought was really, really good was with AHT and GTT. I mean, it's no secret so far, right, that those were two pretty big losers for us. We took majority of the AHT stock loss in that prior week for our profit tracker purposes, because that happened directly after hours. There we go. YouTube looking good. Now it's working. Twitch is looking good. All right, thanks guys. I love to hear it. Sorry for the for the initial technical issues that we were running into. But getting back to what I was talking about, the best thing that we did was get out of AHT and GTT. While it sucks, and we, when we go to our trade performances on the year, we've got a 90% win rate, and we try so hard to protect the loss number, because that really affects this more than the wins, if we're able to eliminate or reverse some of these losses. And that's kind of admittedly why I'm so stubborn on PSTH and ICLN. But sometimes one of the best things that we could do is just get out of a trade if we don't think that there's that much potential going forward, right? And that's exactly what we did with GTT and the AHT. You'll see that we took a $1,200 loss, which objectively on one position in 1 week, is not fun to take, and that's not what we're shooting for. But GTT, it didn't go the way we wanted. We had some pretty bad luck when they announced a surprise delisting, and that just kind of comes with the territory when you're chasing premium a little bit. And again, the idea is that we're diversified enough between all these different things where, a $1,000 loss gets canceled out pretty easily by the rest of the stuff that we've got going on in the vicinity of that play. So, with that in mind, it sucks this moved against us, but the best thing that we did was just get out of the play. It dropped down to, I think, $1.30, $1.35, and at that point, we were able to close and buy back our 2-strike puts for 70 cents. And it was one of those things where, the extrinsic value on the puts that we sold for GTT, and it was gone. So what we had basically was a glorified long position in the stock, and you get to the point where it's okay to keep holding on to that and waiting for a bounce, but with all of the plays that we're holding on to and that we like to have in our portfolio, we want some sort of downside protection or downside cushion on the trade so that if something goes wrong, we're going to be okay. When the extrinsic value on an option you sell is completely gone, you no longer have that downside cushion. So that's a situation we found ourselves in. It was a little bit too risky for us, so we got out with the $1,200 loss before it got any worse to preserve some green profit on the week. And GTTN, the extra little tidbit there is it finished at 87 cents at the end of the week, meaning this would have been worth about $1.13. So we took an $1,100 loss, but if we held on, it would have been even worse. It would have been a $2,200 loss. So even though we lost $1,000 on the trade, a better way to think about this is that we saved ourselves $1,000 more by getting out when we did, freeing up that buying power and locking in a smaller loss. It's okay to take small losses. What gets frustrating is when you have one play that turns into a big loss and throws off all these other plays that you've got lined up for the week. And to continue on with that point, AHT, same exact deal, right? This thing got down to, I think it closed at 232 on Friday. So whereas we lost $430 on the shares this week, we would have lost $810. So we saved ourselves, $400 here and $1,000 here. We saved ourselves about $1,500 this week by closing out of these plays and just writing them off as losers. And while it's ugly to look at these things and see, two red rows in a sea of green, what you've got to rely on is the fact that, with the strategy that we're running and the plays that we're making and calling out together, we're going to have this sea of green results to, make back any of these losses, right? So cumulatively, these are what, a $2,700 loss, and we could just pick up two plays right here, like ORPH and DraftKings. Those two by themselves pretty much even out that loss right there. And then we've got all this down here that we're looking to collect in the future, and all this up here that we've collected in the past. I mean, you could see our profits, you could see our win rate. I'm probably sounding like a broken record at this point, but lock those small losses in. Don't let them get out of control like you see with LOTZ, like you see what we did up here with CLOV, VGAC. Those are the ones that hurt. One of the biggest things that we're learning as we move throughout the year is we're going to have a lot of winners. Just make sure your losers aren't wiping out the entirety of the winners like we didn't do so well up here back in, February. And that's when you look at that year-to-date summary chart. That's kind of what was going on in this area. We were losing pretty big on those. We're eliminating those from our positions, locking in smaller gains so that we have a little bit steadier of a, P&L chart here. And that's something we've been aiming to do after we talk so much about the fact that our profit and loss chart kind of looks like a mountain range, which is fun on the way up, but, not the most fun to live through on the way down. So we're trying to flatten it out a little bit, take advantage of the head start that we've got on the market this week. But with that said, GTT and AHT being two things that we did well to get out of this week, that is pretty much all I want to talk about from last week. So with the 5-minute stream timer, with the stream restart, and then the recap, we're about, just under 30 minutes in. So hopefully we can focus the next hour up here on upcoming analysis for the market this week. And I do want to begin that just, the way that we normally do with this upcoming week analysis by looking at what we are currently holding headed into next week, because, we kind of put our money where our mouth is, right? The things that we think are best for the upcoming week are the things that we're currently holding on to. So I'm going to take a big sip of water before I jump into what we're holding for this upcoming week. And then we're going to talk all about them and then more. If you guys have some stocks that you want to take a look at, feel free to throw them in the chat. I'll put them on my list, and we will definitely make sure to start getting through those. And once again, the never fails, the cold sip of water after I've been talking to myself for half an hour in my bedroom is always incredibly refreshing. Jules, how's it going in the YouTube chat? Throwing a howdy in there. Glad everything technically is working again. You guys can hear me. Hopefully you guys can see what I'm doing up here. So let's go top to bottom. Here we go. Uwmc, we've talked about this one. We've pretty much beaten a dead horse. ICLN, PSTH. One thing I'm seeing right here for those of you who are still in on it, when I take a look at the options chain, let me pull up PSTH right here for you. Formally, and I think the best way to see this is if we go to our breakout tab here as well. When we sell these weekly calls, or sold these weekly calls rather, we were getting 55 cents, 30 cents, 25 cents, 30 cents, a decent 20, 30, 40 cents, every single week after week after week on these things, which very effectively drove down our break-even price and got it to a very manageable point where it is right now at 22.31. However, when we look at the weeklies for the upcoming week, that's going to be July 16th, we don't see that much premium anymore, and it's almost a little bit concerning. The options market seems to suggest that, any potential upwards or downwards movement or volatility in the stock is kind of gone, right? Even though over the past year we've seen a range between 21 and 34.1, you can see right there at the peak. For how wild of a range we have, the fact that we could sell a call that's only 22 cents out of the money on the upside and only be getting 10 to 15 cents a piece on those is kind of surprising, and almost one of those situations where we watch stocks like this so often and say like, oh my goodness, it's okay to be bullish on this, and we're pretty comfortable with this stock at this price point and where our break even is for the long term, so we're happy to keep playing it. But we're in a situation where, is it even advantageous at this point for us to sell covered calls if we're capping our upside at 22 cents a share for this upcoming week and only getting 10 to 15 cents of premium in return? And that is where, we say a lot of the time that the strategy we run, option selling, works so well for so many different stocks, but there are some situations you run into where an option selling strategy, admittedly just isn't the best for that situation, for that specific stock in that specific period of time. And that's kind of what we're looking at right here, right? We've historically loved the premium on this because, like we mentioned, 30, 25, 30 cents, 25 cents, 55 cents. Like, we're able to get some really solid premiums. And as Sierra has beautifully put into the chat for us, she's thinking the option premium is gone because we're coming up on the Spark PSTH from Mainco split. And, a lot of the questions on how options will look after that. So some uncertainty coming up with the structure of this, right? They're going to be merging with United, not United. Why is the name of the SPAC merger is totally escaping me? It's Music Group, United Music Group, UMG. Feel free to correct me if I'm wrong, but I think that's what it is. But yeah, so there's this really complicated corporate structure surrounding this SPAC merger that, admittedly I have not spent too much time looking into. So as far as what I've read, it's gone a little bit over my head. But, from the context, UMG, there you are. I love it. Love having the backup there in the chat, Sierra. But one of those things where a little bit of uncertainty going on in, what's happening in the near future with this stock. We don't see a lot of premium. It might be a smart one where, I admittedly am super stubborn because I'm so close to getting my break-even price down below where, the price of the shares are. It just might not be a good idea to sell calls this week. Or I can go further out to August or something and look at 22.5, get myself, get that basis down another 45 or 50 cents. So get it down to 21.80, which means, if PSTH trades flat between now and August, I'd be making money. And then, just go further out to where you could find that premium. But looking at the chart, one of the things as far as, and then Sierra offering her services in the chat to anyone who wants to come into the Discord. I think Sierra, even Morpho, I don't know if Morpho is here on the stream tonight, but I would consider them our resident PSTH experts because they have done all the research, Sierra's been holding it down in the PSTH subreddit, I think, too, protecting all the investors out there. So she's working overtime for them. So she's the resident expert on that one. I will happily defer to her. I feel like I know a lot, but I'm also smart enough to know what I don't know. And I think Sierra has done a great job of filling in the gaps of the knowledge on this one. But I think if we plot implied volatility here, that could also be something decently interesting to look at because I would imagine it's just falling off a cliff. And I've totally whiffed on it right there. I whiffed again. 0 for 2. 3 strikes. I'm out right here. Now we're good. Yeah, you could see here, this blue line for implied volatility is just completely being driven into the ground. This is about as low as volatility can get and as low as it has gotten over the past year for this one. So that's something that's decently, almost surprising, right? Because when we sell options, we're kind of short volatility because if volatility decreases, the premiums on the options are going to decrease. And we're going to make money from, the price of the options that we sold going down. That's kind of the name of the game. That's what we play. So when conditions aren't advantageous for option premium, it might be a good idea to just forego that. So I think even though I've got this on my weekly tracker listed as, I want to sell PSTH calls on Monday, I might leave this one alone for now until something happens. If the stock runs back up to 22, I'll happily dump it if I can get some stock gain. And even though it might be a small loss, I just gave the whole little miniature speech about how taking small losses is good sometimes to avoid being, dragged down by big losers. So I probably would be wise to heed to my own advice there. But, I've got this highlighted to sell these calls Monday. And if premium doesn't look any better, if nothing happens with the stock, I'm going to leave this one alone until something does happen. Then I could recover the shares. So these are going... I might as well just highlight this red as a note to myself. This is going to be deleted. Actually, why don't I just delete this live right now? I'm just going to be holding on to these shares uncovered because the premium does not look that great. Now, looking back to where premium is great, CRSR, Corsair, we talked about that one already. The great part about this is, premium is still so jacked up from how quickly up and down it's been moving. Just off the call premium for the next 5 days, we're going to pull about $720. And another good tidbit to add from Sierra in the Twitch chat is she thinks the only chance for a run-up is going to be the day before the date of record for UMG. So if you know which day that is, that would also be super helpful, selfishly for myself and my investment here. That would be great to know. But yeah, Corsair, we love this one, right? Because no matter what the stock does, we're getting $720 for free. And you might say, for free, well, doesn't that cap your upside at 32.5? It absolutely does. But if we run into that quote unquote risk, we're still pulling $1,800 next week just off of Corsair. So that is a risk, quote unquote, that we are perfectly happy to take. Dashio saying, what about those 22 calls, I guess, on PSTH? For me, I think the point really is that, there's 10 to 15 cents of premium. Look, if I can get 15 cents for a 22, all right, I might leave the order open. That'll get my break even down to 22.16. But, for how much this thing's moved, right? Even if we go back to the last 20 trading days, it has a range between 21.73 and 24. At June 23rd. This thing was trading at $24 a share, and I think this is right around merger dates, so we had some stuff going on with that. But the point is, I think there's still a little bit of life left in this one. It's trading right around net asset value. I gotta think we're getting near a base, and even if just in the short term, I think we can get a bounce above 22, and at that point, I'll probably look to cover at 22.5 or above. But for now, this just is not a great value proposition. I don't like the premium in exchange for the upside that I'm getting capped on. So going further down the list right here really quickly, CRSR, we were happy about that one. SPX, another just hedge that we have on because we have all these options, 716, 716, 716, here. We have all these plays that are bullish that are expiring this Friday, just so if the market crashes, I at least want to say, you know what? I've got $1,000. So that is the purpose of that. And it's looking so far so good. Expires Wednesday. We like to have those expire Wednesday again because that's typically the day the least happens in the stock market, in my opinion. On Mondays, you factor in a little bit of volatility over the weekend, and on Fridays, a lot happens Friday afternoons in the market. So Wednesday, for me at least, that's typically a nice, more relaxed expiry to have for those SPX call spreads. And you can see right now /ES that we've got up there. Those are the S&P 500 futures, and those are already down about a tenth of a percent. So that's decent red right there. But it's 9:38 p.m. Eastern. We are 12 hours, just under 12 hours away from the market opening tomorrow morning. So there is a lot that can happen between now and then. So what we like to say about the futures always is, if they're going the way that you want them to, then they matter. But if they're not going your way, just don't worry about them. They're not important. So tons of confirmation bias in my analysis of futures pricing. IPOF, really happy with this one as well. I mean, maybe not how it's performed so far because we bought them. And again, that's our big option buying play. We bought those for 41 cents. They're down to 35. So we've lost, about $100 on those. But that's okay because we saw a little bit of life in IPOF at the back end of last week, right? It certainly doesn't look like it on the one-day chart, so we're going to have to bump it into the 20-day. But, it dipped below 10 and then got back up to the 1020, 1014 level. And we know our break-even price is this red line that we drew right here, and we've got 2 months to wait, right? So we've seen spikes up to 1065. We've seen spikes back up to the 11 level. If something crazy happens in the next couple weeks, next couple months, and they announce a merger target and we get a jump back up to the 12 level, these things are going to be worth $2 a pop, and we're going to be taking home a really, really nice gain on that play. But the point of that is, even if the worst happens and it drops below 10 by September 17th, and these are totally worthless, we've lost like $1,000 over the course of 2 months, which is something we're very capable of recovering. But, I love, at least to some extent, having this unlimited upside play where if something crazy happens and IPOF goes up to like 20, these would be worth 10, and we'd, be sitting on a $24,000 gain. So that would look really, really nice on the chart right there if that did happen to us. But I like the idea of, instead of having all of these short option plays where, we're going to get steady, consistent gains, but potentially one morning could wake up to a big loser, the potential, for a big winner as well. So that is one that I'm happy with, and I'm probably going to look to have more of those. I've mentioned this briefly in the Discord, but I'll definitely be looking to have more plays like this. Maybe not more plays going, but always have one play like this going at all times, so that, potential lotto tickets. So if something goes really well for us, we'll be able to cash out a decent gain. ORPH, that one's looking really good. That's well above 5. It's at like 6 or 7 right now, so I don't think there's much risk of that one in danger. AHT, we have these naked 5 calls that we sold as part of our covered calls. We dumped the stock, but not these, which are going to net us literally $20. So we're probably going to look to close those on Monday or Tuesday just to get out of them. And then BBIG, this one is great because, we opened this on the same day as AHT. It was a similar trade idea, but what's great about this one is after hours on Friday, this thing ran up to 417, settled at about 410. So we're going to be looking at a really nice share gain on that one, right? So if it finishes anywhere above 4 this week, we know those shares, are going to get called away for $4 a share. These are going to expire, we'll just get all the premium from these. So we're going to get like a $500 gain off these if BBIG finishes above 4. And if we look at that in the context of the overall trade, not too bad. That would be a 20% return on capital in 2.2 weeks, which annualizes to almost 7,000%. So super happy with that one. Hopefully that one stays above 4. We could realize this gain. And, sometimes I always say it's the super small plays that we go on into that give us some of the best returns sometimes. But at the same time, sometimes those super small plays, they're smaller because they're a little bit on the riskier side, and we could run into a situation like what we had with, AHT or GTC. So it's sometimes for the best to keep those things smaller. Down to Vislink, that's one we're just going to be holding on until August. Our break-even, unfortunately, dropped pretty quickly off the bat on us. Our break-even price is around right where the stock is trading right now, so not the greatest start to that one. But again, we like to talk about these home run plays that we have set up in the background just in case something crazy happens and if Vislink makes it back up to 5 by the time we get to August 20th. Then we are going to be sitting on a $7,000 gain just off that smaller play. So perfectly happy with that one to sit back and wait. And the call premium on it has looked really good historically. We could pull up the chart here so we could see what's been going on over the past 180 days. All sorts of volatility here. Does worry me a little bit, admittedly, right? That, we've got this base at 210, 215, and if we break below that, we could see about $1.75, and that might be hard to catch up with. But going forward, there's still decent premium on a month-to-month basis. If things get really bad, we could roll down to a 2.5 strike call, but we've also opened this with a smaller amount of buying power. So I think the better move, if it drops down to the 250 level for us, is just going to be selling these August 2.5 strike puts, which will let us get shares at that $2.10 range, which again is that lower end of end of support that we like to talk about. So if you don't have a position on these, I think these 2.5 strike puts look really nice. You collect 20% roughly in a month, and that's ROR, pure return on risk. So not taking any broker leverage into account. That's a pure 20% return if this thing finishes above 2.5. And with you getting 40 cents of premium on a 2.5 strike put, we know that your break-even price, I'm clicking random things. We know with 40 cents of premium on a 2.5 strike put, your break-even price is going to be sitting down there at about 210. That is right there on the chart, and that lines up with this base, and the bottom of these candle wicks that we see right there. So really strong area of support. Can it get back down to this level? I mean, absolutely. Anything is possible. I mean, it could shoot back up to 10. But as is always so important with our strategy, we love, just doing everything we can to protect ourselves and being conscious of that downside risk. And this is where it lies. Now, this $1 trading range happened, in October, November, December of last year. So I don't think it would, be a 1 month or 2 month thing where it pulls back to here. So I think we'd be able to have at least a few months of being able to collect premium and getting that break even down further. But I think 210 is a great entry, and selling those 2.5 strike puts is a great way to accomplish that. So if you're looking for a smaller play, that 2.5 strike, only, it's less than $250 of collateral to sell that thing fully cash secured. So I think that's a great place to start out. And we're finally, starting to get towards the bottom of the list here. ALEC, this is a great one as well. The premium at the back end of last week dropped a decent bit. It went from 88 cents to 60 cents. So we're cleaning up a bit on that side of things. But we talk about using, generally option selling, but using our option selling strategies in different ways and coming up with these different strategies. So what I've decided to name the strategy that surrounds this ALEC play, and is the same strategy that is involved in CERE, ASTS, and ORPH, which have all been really successful plays, is we're going to call this one the IV reversion play. And as of right now, it is 5-0. We've got an average return of 10.03% in an average, trade time of 1.69 weeks. And we've made just about $5,000 on it since we've started putting that into play. So what do we mean by IV reversion? For a good example of this, let's pop over to CERE to explain exactly what this looks like. A lot of you who have been following along are going to know what we're talking about here. But IV reversion, like we mentioned, we like to be short volatility because volatility, when it spikes up like this, it's temporary. And when it spikes up like this, you see a ton of premium getting pumped into these options. So what happened here, we had this biotech stock that was trading between 9, 10, 11, 12 bucks. Was trading around, pretty much right on 12. When they had some really good news come out, when, if you've got a stock that's trading at 12, good news comes out, then the stock, hypothetically, it's going to be worth more than 12. So what do? We sell, as you can see right here, a 15 strike put. So we know if it was trading at 12 before, if you sell, it's conceivably worth a lot more than 12. And as you can see from the share price shooting up to 33.8 at the very peak, a lot of money is being pumped into this thing. So 15 is a very, very easy price to get into. But the best part about CERE, and when we entered this thing, is we were able to get 44 cents of, 44 cents of premium for the 15 strike puts. So we know that puts our break-even price, this red line right at 15 is our max profit, but with 44 cents of premium on those, our break-even is going to be at about 14.56, which is, just slightly lower than that. But again, if we were to have to take assignment of those shares, you've got a company that's worth more than this level right here and has traded in that range for, majority of 2021 so far. So it's a great place to get into. But the question is, the stock was trading at 27, 28 bucks a share when we did this. How on earth did we get 44 cents of premium on a 15 strike put? And the answer is implied volatility. So when the stock shoots up, regardless of the fact that, good news came out and this thing's, conceivably going to stay up here for the near future, this rapid of a move up from 12, where you've got these huge candles and it starts trading up at 28, 29 and breaking 30 at one point, that creates this enormous amount of implied volatility, which we can see charted down here by the blue line. And like we mentioned, a lot of these volatility spikes are largely temporary in nature. But for the purposes of what we're doing, what's great about these volatility spikes is that they pump so much premium into the options. So if you look at a 15 strike put that expires in we sold this on June 30th. So you've got a 15 strike put that expires in 2.5 weeks for 44 cents, which is a phenomenal return. Not to mention the fact that our broker offered some really nice leverage on that to make it into a very, very attractive return. And, it's so low stress because you've got a stock trading at 28, and now your value proposition, if you're just looking at the potential outcomes of the trade, you're saying, hey, we got in on a stock that's trading at 27, 28 bucks a share. And as long as it stays above 15, we're going to make max profit. And max profit for us on this trade, if I could find it right here really quickly, is 8.57% in 2.43 weeks, which is a 481% annualized return. And again, you're getting that awesome return number just if it stays above this red line. And to me, that is just like a mind-blowingly good value proposition, all made possible due to the spike in implied volatility from this big upwards move. And that's just how options fundamentally, the pricing formula is so heavily driven off implied volatility that when it spikes, even when you're so far away from your max profit point, you're going to be able to get a decent number that gives you a decent return that annualizes to an awesome amount. But, as we've tracked more of these, we've done 5 of them so far, and they're all looking to be winners as things currently stand. But that's what we're currently doing. That we're looking at CERE right now as an example, but that's what we're doing with ALEC, another biotech company. Hey, there he is. We've got Marcus in the YouTube chat. I will 100% happily give him a shout out for calling out those. He's done an awesome job at identifying opportunities like that, and I can take 0 credit for this. I can 100% happily give credit to Marcus from the YouTube chat and our Discord for pointing out some of those awesome opportunities where, implied volatility is shooting up and we're able to pull off some trades like that. So great job there. Another example of how we can all just win at these together. This doesn't have to be he found something so he's in it, but I can't get in it. But we all get in it. We talk through these trades together. We evaluate them together. We throw ideas off of each other. And, in the end, the idea is we all profit together. So appreciate that. And I will, he's saying it, I'll happily crown him the king of Vega plays. So we are 100% going to have our eyes open to more of those going forward. And ALEC is an example of that, right? Very, very similar setup to CERE. You've got this good news that came out on a healthcare company. The stock shot up. CERE was previously trading at $12.74, but we look at ALEC, and that was previously trading at 21. So you've got the stock that was trading at 21. Good news comes out. It's conceivably worth more than 20. So what do? We played a little bit safer because if you look at the 180-day chart, this thing was trading about $9 half a year ago. So you want to be a little bit safer. Whereas when we look at CERE, it has a little bit better of a longer term base. ALEC, it was trading at 50% of what it was before the big spike, but that's beside the point. That's why we decided to go with 20. What's important here, though, is the fact that even on those 20 puts, thanks to this bump in implied volatility that still hasn't quite gone away yet, we were able to pull. Let's try to find the first week that we opened these, and I think it was right here. We sold ALEC August 20 strike puts for 88 cents a pop. And again, 20 strike means that anything above this red line is our max profit. 88 cents a premium means that 19.12 is going to be our break-even price, and that's a little bit lower right around here. So one of those things where, look, if it does come crashing back to the ground, which conceivably it won't because they were trading decently, had some really nice news, we would be okay holding these shares at 19.12 just because that's historically the range it's traded in. And if it fell from 34 down to 20 in the next 3 weeks, 4 weeks, the amount of volatility that would create would make selling covered calls on the other side even easier. Shout out to Boca Rio Golf Course for subscribing. All right. All about the golf courses. So popping back over to this trade, right, there's still some decent premiums left on these. Volume isn't through the roof, obviously, but decent premium left on the put side. You could still get, if you wanted to go 22.5, you could get about $1 something a premium on those. That's not too bad of a value proposition. And again, like we mentioned on the call side, there's still so much premium left out there, right? We're looking at August specifically because July you can't really go back down to that base level to get any premium. But if it falls back down, you're looking, if you want to go at the money, you're able to get $5.20 of premium. So if we were assigned at $19 a share, sold an at the money call for $5 a premium, our break-even price is now down to 14, which is incredibly manageable in the scheme of things. So that is why we're super happy with that one. That's one we're hoping to bleed a lot more premium out of in these upcoming weeks. But when we talk about these IV reversion plays, that's what we're going to be referring to. Newegg, we've got some stock suggestions rolling through the chat, and I'm not forgetting about those. I've got these all written down. I just want to get to the bottom of this list, and then I will happily pop over into what's been going on in the chat. So bear with me for a second, and I am going to take one more sip of water real quick. Okay, so the next one I want to talk about is going to be Newegg. And this was an interesting one because we also had a similar IV reversion play set up with this. I think this is incorrect. This was a 12.5 strike put. But regardless, when we pull up the Newegg chart, what do you notice? It's a very, very similar setup. However, with this one, the price movement dwarfs what we've been seeing with the other stuff. This thing had so low volume, so low movement before that, implied volatility wasn't even registering for how we have it charted on here. But, long story short, this thing had been trading, pretty much since May, and even going back to last year, right around, oops, this is still this year, but this year around February, it was still trading at this $10 level, $8, $9, $10 level, and it had been trading there for a decent amount of time. Then all of a sudden, this thing shot up to 20, and when it shot up to 20, there was some incredible premium still left on the 10, and I know we have some people in our Discord who are able to jump on those. I unfortunately had my buying power a little bit tied up, so I couldn't get in on that. But, same type of setup. If you zoomed in right here, it would look very similar to what we saw in the biotech plays. But as you just saw before I zoomed in, this thing went through the roof off no news at all, right? So what we saw with those biotech plays is they had good news come out, and that caused the stock to spike. So what's interesting about this one, it was kind of a low float company getting squeezed. There wasn't actually any good news surrounding the company that caused this. It was just mass buying focused on one stock where a lot of people were short and there weren't a lot of available shares. That's causing this insane price movement. But, we love the insane price movement because implied volatility is through the roof. And what we were able to do was sell, I think, 12.5 strike puts. I might have to look back through the trade log since I know that I messed up what I wrote in there in the first place. But we were able to get roughly 30, maybe these weren't 12.5. I'm gonna look really quickly back at the Discord server for when I called this one out to be 100% sure about what the strike on that was gonna be. So I'm scrolling through here. Yeah, it was a July 16th. That's insane. We did this on July 8th, right? So Thursday. We sold a July 16th 12.5 strike put. So if we zoom in here, Thursday is going to be the 8th. So just from the volatility of this thing dropping from 63 to 44, I was able to sell a put with the max profit point right here and get 35 cents of premium. That is nuts. That's like a 3% return on those. And that's assuming you sold it fully cash secured, which, I think the broker required for this one just because the movement on the stock was crazy. But, almost as close to a free 2 to 3% return in a week as you can get in the market. And the great part about this is you could see, volatility tapered off a little bit when this thing leveled out around the 40 area. So I was able to close those out within a day for 15 cents. So we're able to get a 1.5% return in 1.5 days. Which is I'm very, very happy anytime I can pull off a trade that looks like that. But getting to the point of what I'm holding on to for this week, I've actually kind of changed course, right? So the premium on those far out of the money puts that we normally like to look at for the IV reversion strategy, not a lot of premium left on those. You'd have to go up to the 20 level to start getting 1.2, 1.5 ROR again, and that's just not an area that I'd be comfortable holding this thing at because as we saw from the chart, right, it's been trading at 10 or lower for the better part of the last year. So that's something, definitely a lot of downside potential on this. So that's what I'm wary of. But speaking of that downside potential, what I did was I sold a credit spread on it with a 60 short leg and a 65 long leg. That means we sold a 60 call. We bought a 65 call. The difference between the amount of money that we sold the 60 call for and the amount of money that we paid to buy the 65 strike call is the credit we got, and that credit was, if we go back up here, $1.10. So what does this mean, right? If these both expire worthless, we're going to hit max profit because what we sold the option for was worth more than what we paid for the option. The difference in what we sold it for and what we paid for it is $1.10. And we know per spread, since each options contract is for 100 shares, that's going to be $110 at max profit per spread that we sell. And we sold 10 of these, so at max profit, we're getting $1,100. But what does it mean, right? In plain English, what does this trade mean for Newegg that we have set up? And it means by August 20th, since that's the expiry that we sold, as long as this thing finishes below 60, we're going to hit max profit on this trade. So what does that look like on the chart? So as long as, by August, we have over a month for this thing to work itself out. If I could figure out where to get to the drawing tools, there we go. As long as this stays below 60, we're going to hit max profit. And if we zoom out against that 1 year, I think we have a very, very good chance of that. Now, you might say, why not just sell a naked call? Because you'll get more money. But the issue here, right, is you've already seen this thing spike up to 79 once. I mean, there's no reason it couldn't have a similarly crazy spike to GameStop, but as we know with GameStop, right, this thing went up, this thing went back down in a matter of just weeks. So while there is one big event that is potentially very scary that could happen with Newegg, and not making any prediction suggesting that this kind of thing is going to happen, but just in case that kind of a thing happened, I don't want to blow my account up on this. So using the spread caps your upside risk, right? Since you have the 65 call that you bought behind it, that would make money if you had a similar jump up to like $400 or something crazy happen with Newegg. But with our August 20th expiry, we now have all the time in the world to sit back and wait for this thing to come falling back to earth. Anytime you see a squeeze like this with no company specific news lined up and it's just running through the roof like this, Ivy is crazy. That is a sign that, in the short term, it might keep squeezing up, but in the long term, it is going to come crashing back down to earth. It quite frankly is just inevitable. So as we wait for that inevitable collapse, we sit back hoping it stays below 60. And if it does, by August 20th, we're going to cash out $1,100. And I love the value on that play because that, if you want to have that fully cash secured in your account, there's $3,900 potential loss. So an $1,100 profit divided by, and I can pull the calculator up here really quickly as we like to do so often to do our calculations in front of you guys, but an 1,100, come on, an 1,100 profit divided by a potential max loss of 3,900, and that'd be the collateral. You're getting a 28% return on your money in just over a month on this, provided that it inevitably falls back down and you've got plenty of time to wait for that. So I'm very, very happy with that play. I was thrilled to be able to get a fill at $1.10, and I'm just going to be sitting on that for the next few weeks. SOL, when we play all the time, right? It goes up, it goes down. It's this solar energy stock. If we zoom back into the last 20 days, last time I got back down near 755, it bounced up pretty hard, almost all the way back up to, it looks like it did hit 10 a share before it came coming back down. And what we do, I don't know where that accent came from. It's getting to be that time. We're about an hour in. But what we like to do with stuff like this, when it gets down to this level where we see a lot of bounces, we sell cash secured puts at 750, as you see that we've done right here. So if this stays above 750 for the next week, we're going to bag about $200 off that. But if it bounces back up to 10, we'll take our max profit, leave it alone, wait for it to fall back down, and get back in with those 7.5 strike puts, and that's what we're sitting on. Max profit line is right around here with the 20 cents of premium that we got on those. I think 730 is the break-even price. So as long as it stays above, 730 right here just over the next week, we're making money on the trade. And value propositions like that and potential outcomes when stated in plain English like this are exactly what we're going for when we're setting up plays like this. High percentage, consistent returns with high probability, and that is exactly what we're shooting for. That's exactly what this is, and that's exactly what's going to get our returns looking just like this, moving up and to the right steadily and consistently week after week. DIDI, this is one, admittedly, I was a little bit asleep at the wheel for because it was trading at 11.10 this week when I entered into it. This is the Chinese ride-sharing app, which IPO'd a little over a couple weeks ago, maybe? Oops, that makes it look absolutely ridiculous. Yeah, it IPO'd a couple weeks ago, right? And, opened up at like 1650, dropped immediately, rose back up. And then this big red candle that you see right here between June 2nd, which was a Friday, and then June 6th, which I think is the Tuesday that the market opened up after that, is due to the fact that the Chinese government pretty much restricted their apps. So that is one reason I don't typically like to invest in a lot of Chinese companies, is because the regulatory environment over there is just nothing like what we have over in the United States. A lot of the companies are just kind of at the mercy of what the government is saying and what the government's mandating. That's exactly the situation that we saw unfold with Didi. D-I-D-I. I don't know if is Didi how I pronounce that. That's what I'm going to be rocking with. But, that's what we saw. The big red candle created a lot of volatility, and then it kept dropping right into this 11.10 range when we saw it last Thursday. And, we thought that was almost too good to pass up on something that IPO'd at 16 or 17. And with this drop, with this volatility that we saw too, right? We see the volatility spiking up again. That's when we got in on the trade. These 10 strike puts were trading for about 40 cents a pop. I mean, tons of volume across the board, tons of premium across the board too. You could still get a decent amount of premium on 9 strike puts for next week, but that is beside the point. We went with the 10 strike put. We like the value proposition that those set us up with, right? We got 40 cents of premium, so our break-even price, where you have to zoom out to get to it, is 960 as far as this upcoming week is concerned. So as long as it stays above that red line for the next 5 days, we're going to be good to go. My original plan, as I called out in the Discord server, was to get out of these for 20 cents a pop, which would have given us another $200. And they got down to 20 cents a pop last week on Friday, actually, back when they had this spike. Where am I looking here? Yeah, we had this spike. Remember, we got in at around 11.10. It spiked up to a little over 12 a share. And at that point, the 10 strike puts that we sold literally 24 hours before for 40 cents were worth 20 cents. So we were at 50% of max profit. However, I wasn't looking. So unfortunately, we weren't able to get those closed out for 20 cents. I put another order to close in for 20 cents. It never quite got back down there. I got down to like 22 to 25. Never filled, but that's all right because our break-even price is down here. And it's one of those things where, if you're buying options and buying calls, buying puts, timing your entry and exit is so important, because if you miss the boat, right, we know how quickly the price of these options can decay. When you're selling options, you could miss an exit like we did on Friday because, you're not paying attention, you get busy, or maybe you just get too stubborn to close it out. But the great part about that is, hey, you missed your shot. Guess what? You could still have the same opportunity present itself next week, just as long as the stock doesn't completely tank. And that's the type of cushion that we always allude to, that we're trading with this kind of a strategy. And that's why we love this strategy so much and are pretty much exclusively in it. So rounding out the list, ASTS, we closed out half of those. Again, this actually ties in really well with the discussion we just had about DIDI, where we sold these for 40 cents, wanted to close them out for 20. We sold these for $1.30, and they got down to 70 at one point. So we closed half of those last week for 69 cents a pop. Nice. And we've got 5 left sitting in there that are trading at about 70 cents a premium. So if that finishes above 12.5 next week, we're sitting at $350 a profit, but we still got an 11.80 break-even price, which when we pull up the ASTS chart, not too bad, right? We've got that plotted out. In the overall trade, you'll see this red line up here for our max profit point. And then you'll also see this line down here at 11.22 because we sold these things for $1.30. Yeah, great point by Marcus in the Twitch chat. Having the buy to close order is incredibly important on that, because we would not have been caught sleeping. You don't need to be sitting there watching it all the time. Sometimes if you sell something for 40 cents and say, hey, I'm going to buy this thing back for 20, just putting in that limit to close order for 20 and letting it sit takes all the stress out of it. Incredible point. That is something, again, we just completely got busy, got sidetracked. But again, that's the great part about the strategy that we run, is the fact that you don't need to be glued to the screen 100% of the time. You could do things like that we talk about, setting a limit order. You could be incredibly busy. We work a full-time job that's pretty demanding and don't have time to be glued to the screen. So a lot of what we do can be planned around that, which is great. But again, ASTS, another interesting thing about this one is if we back up a bit, you'll see a big green candle with some decent spike and implied volatility right here. And this was another one that we went in on that IV reversion thesis, you could say, where we got in when the stock was trading at about $13.50. It's dropped all the way back to $12.84. So we opened a bullish play and it dropped on us, but we've made money overall with the 12.5 strike puts that we sold for $1.30, now going for 70 cents, because the implied volatility is pulled back a little bit. So that's just, further hammers home the point that we were making about the implied volatility reversion strategy that we've been running in order to take advantage of when we see spikes like this, because it historically works out very, very, very well. So we are going to keep it up with that. And then shout out to Handpay Harry in the YouTube chat. He's shouting out Axia Coin. I know he had a very big win on that one, getting in on the ground floor of a alternative crypto. So love to see that. I'm loving, no matter what the strategy is, when anyone who's following along with us is winning. So we've already talked about CERE, and that finally gets us to the bottom of what I'm holding for this week. And like I mentioned, a lot of the analysis about what I think is a good play for this week pretty much already lies in what I'm already holding, because as we mentioned at the top of the stream, we're putting our money where our mouth is, right? If we think something's good, we're gonna make that play. So objectively, what I think the best plays available in the market are what you're gonna see right here. Now, what's gonna be helpful right now as I go through the list of some of the stocks that people have been throwing in the chat here is coming up with more ideas, right? Because even going into last week, or even 2 or 3 weeks ago, you'll see what we're holding is entirely different than what you see when you scroll down just like 2 or 3 weeks. And that's the point I like to make about the strategy so much, because a lot of people say, hey, when you're selling options, if you're back testing it against, the S&P 500, you're back testing selling options on the S&P 500 against, buy and hold performance, you're going to underperform. And they're 100% correct. If historically that's what you're using to back test, you're going to underperform. But the idea with our strategy is we're targeting option premium, and option premium, even as we saw with PSTH when we took a look at it earlier, it's always changing, always moving up and down. And what might be a good play for us one week, maybe not a great play next week. And what might be a bad play this week might be an awesome play for us next week, depending on, volatility in the stock and premium that we're seeing in the options that we want to sell. So anytime you're online and seeing people say, if you back test running the wheel on this stock or running the wheel on the S&P 500 over the last 5 years, you're going to underperform. And again, that's not the point, because we're not going to play one stock over and over and over and over. We're going to have a decent group of stocks that we can move between, identify new opportunities, and jump into things when the timing is right. So that is what we're going for with our strategy. And while, again, like I mentioned, these are what I think were, as of Thursday or Friday, some of the best things to be holding, generating new ideas. A lot of these trades that I'm in right now, I didn't even have them on my radar a week or two ago. So, keeping your eyes open, listening to ideas from other people. We like to throw ideas around to the Discord server, and doing what we're about to be doing right now. Here you go. This is finally the segue I was trying to get into. But doing what we're doing right now, when you guys are helping me out by throwing stocks in the chat that we're going to run into and analyze really quickly, is a great way to identify more of these opportunities while the market is always changing. Being able to identify the opportunities that best suit our strategy, or what is going to keep you, being able to consistently profit week after week, get bigger and bigger cushions when you're trading and running the wheel and selling spreads on these things. And that's what's going to make you a consistent winner and, be able to outperform the market in the long run. And that's, pretty much all we're trying to do here. And so far in 2021, it's been a blowout. So hopefully we're going to be able to keep that up. But with that said, I feel like I ramble a lot. So feel free to tell me to shut up in the chat. I'll happily keep it moving. The first thing I want to look at is SPCE, the ticker Virgin Galactic. I'm going to write down a quick list. I'm just scrolling down the chat here to make sure that, if you guys suggested something, that I'm confirming I'm seeing it. We got CLF in there. We've got STEM from Prinsmeister. Shout out to Prinsmeister. And I said that slowly because I was writing it down as I said it. We've got Jules wanting to look at Roku, Apple, and NVIDIA, if that's how you pronounce it. Honestly, I have no idea. I've only ever read the word, to be honest with you, so I have no idea how to pronounce that. We've got JP in the YouTube chat throwing some stocks in there. We've got GXGX, APT, and EXEL. All right, so I think that's a decent list to get started with. We're just over the hour mark, but maybe slightly under an hour of content with just what had been happening on the technical difficulty side of this. But let's get into it. Top of the list, we're going to take a look at SPCE. Again, Richard Branson's Virgin Galactic, which if you've been paying attention to some of the news that's been going on in the stock market, they had their launch today where Richard Branson was put up in the jet and taken off, launched into space, where he had zero gravity for, it seemed like maybe a couple of minutes, and then he re-entered the atmosphere and safely landed back down in their site in New Mexico, I think it was. But even in general, irrespective of the stock market and the implication for what we're looking at right here, for our purposes, super cool moment to watch, because it seems like things like that, which have previously been super unattainable, might be available to I wouldn't say the common man right now, because I think the price tag on that is still like $250,000 to get up there, but we're getting closer. I think it'd be cool to go to space. I don't have $250,000 lying around, but, maybe one day. But, the question that is a lot more relevant for what we're talking about is what are the results of today's space flight for Virgin Galactic going to do to the stock price? And this is something where I'm very, very, very hesitant to say, okay, you bought calls, you thought it was going to go up, successful flight equals increase in stock price. Because that isn't necessarily always the case, and you'll always hear the adage of, buy the rumor, sell the news. What makes me hesitant about this is the fact that, back in May, right? This thing was trading at $15-16 a share. That's 2 months ago. Since then, it's basically 4x'd all the way up to 60, and then fallen back down to about between 3 and 4x. So this is all kind of build up and lead up to when they're announcing the space flight. Branson's going to go on it. This is happening. I think this most recent green candle was from the announcement that it was going to be happening today. But, a lot of this buildup is directly related to today's event. So what gives me a little bit of pause is wondering, hey, how much of this is already priced in, so to speak, because people knew the space flight was going to happen. Where I get a little bit concerned is the fact that, Richard Branson wasn't going to be going up in that space flight unless he was pretty damn sure it was going to work. So I have to think there's a very high probability of success for that flight priced into what we saw here. And every time you see these big green candles, there's almost immediately some profit taking closely after. So, I could really kind of see this going one of two ways. The first, right, is that I think there's some decent short interest on the stock. People saw a successful space flight. There's going to be a lot of buying in pre-market. It gets back, breaks this 60 and starts running. That would obviously be best case scenario from the people that are in it. What I could also see happening is all these people who had been holding this stock since 13, 14, 15, 16 bucks are saying, they've been doing so in anticipation of the space flight. And now that event has come and passed with a successful result, let's say this thing's trading at 55 or 60 when it opens tomorrow morning, and you are in that situation where you've been holding shares since 14 or 15 bucks, 4x your money. When you take a look at that position and evaluate what you're going to want to do come Monday morning, are you going to lock in your 300, 400% gains, or are you going to keep holding? Because if the event that you'd been anticipating the whole time has come and gone and worked out successfully, right? Psychologically, that might be the timeline of your trade. You might say, okay, it's time to get out. And I think that's going to apply to a lot of people who have been holding on this run up. They were holding for the flight. Flight's gone. They're going to cash out the profits. Because between now and I guess, the near future for Virgin Galactic, what's a big catalyst, right? They're going to begin commercial space flight. I think they're going to begin rolling that out in 2022. I think that's what was mentioned today. But, that's not a bunch of hype that might be able to sustain such a big run up. And that is what concerns me a little bit about this one. I do fear it could be a buy the rumor, sell the news type event. I think realistically what happens is we might see a little bit of a spike up into this area, and then we'll fall back down and settle into, 45, 55 range where we'd seen previously a little bit of turbulence. I doubt we go below 40. I think the big winners in this one are going to be the people who sold the puts right in this 30 range, because there is a very, very large amount of premium on those, as you could see. 4, 5, 6, 6.5% return on risk if you sold that fully cash secured at 40 strike. That's some very, very nice premiums on this. So I think the people who sold these are going to be the big winners. As always, I always think the option sellers are going to be the big winners, but I think that's kind of my 2 cents on that one. One of those things where, it's great that everything went well today. And I know we've got a lot of people in here who are bullish on Virgin Galactic, so nothing would make me happier than to see this thing shoot up and see everyone make a ton of money. But one of those things where, it's also important to be objective and say what is a realistic situation going forward, because come Monday morning, if you're holding a bullish position in Virgin Galactic, you're going to be faced with a similar choice. Do you want to take your profits, or are you going to kind of, ride the lightning, so to speak? And I'm relatively conservative with stuff like this. I always say book those profits. But that part's up to you. Just be cautious about the psychology of not just yourself as you approach the trade, but also other people who are in a similar trade. What do you think they're gonna do? That's kind of just as important when you're trying to figure out how to handle that. But I think I've said pretty much everything I wanted to say about this one. Not gonna spend too much more time because with binary events like this, a lot of technical analysis and saying, this channel, this support, this resistance, blah, 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 is kind of useless because there's going to be a decent move one way or the other. But I think it remains to be seen what that is going to be looking like. I personally don't have a position in here, so I'm going to be thoroughly entertained sitting back and watching it happen. But will definitely be an interesting one to keep an eye on. So with that said, we're going to move down to a couple... We're going to go to CLF now from Prinsmeister. CLF, we know this is a steel stock. We've talked about this a lot. Cleveland Cliffs. I want to say they got some earnings coming up. Feel free to correct me if I'm wrong. Good way to check that. Throw it in the watch list. CLF, take a peek at the little icons right here. There you go. 722 before market time. 722, not this week, but upcoming week next Thursday is what we're going to be looking at on earnings on that one. So not going to be a ton of premium in this week's options, but next week I think is when you might see a decent bit of option premium. And yeah, absolutely right. So if you look at a 20 strike put for this upcoming week, you've got 0.48% return on risk, whereas if you look at it for July 23rd, not this Friday but next Friday, you see 5 times really the premium on that one, up to 2% ROR. But the question is this a stock that you want to have a $20 basis on? The premium on a week-to-week basis is awesome, and I feel like we kind of come to similar conclusions every time with this. And every time I see a chart that looks like this is kind of my conclusion. If you bump this back to about a year, this thing was trading at $5 a year ago. Even zooming in a little bit to the 180 day, this thing had a base of around $8, $8.50 back last November. So I think the downside is definitely there. I know commodities are a decent place to have some money parked during times of inflation or potential inflationatory fears. Is that inflationatory? Is that a word? Someone might need to grammar check me on that one, but I'm gonna rock with it for now. But inflationary, I think, is the word. Yeah. So, whoops. This is a stock market stream, not a grammar stream. So I'll do better in the future. But inflationary fears, commodities are usually a decent place to have your money parked. But it's no big secret that with what's going on in the economy lately, that there are a lot of inflationary fears. So as that's kind of well evidenced in the fact that this is basically 3x from last November, meaning 3x from the. And there we go. Prinsmeister got me with inflationary. That's one of the things that cracks me up too, having the delay on the stream and the chat. So if I make a mistake, I don't get to hear about it for a good 15 or 20 seconds. So I have a brief moment of peace before hearing about it from you guys. But yeah, this thing's 3x, 4x, not 4x. It's 3x basically in the last 180 days. So last 5-6 months. So that gives me a little bit of pause. And let's take a peek at RSI. I think RSI is also an awesome place to start. And again, it's getting a little bit elevated, and we could look back historically about how the stock over the last 180 days has responded to different levels of RSI. Back when it got a little bit elevated, just got red here as it touched the 70, it pretty much dropped off a cliff, and then when it got back right to the 30 level, it jumped right back up. And as you can see, we're once again approaching 70. Anything above 50 is technically considered overbought. J March is saying CLF is going to kill earnings because they already revised earnings expectations. That is very interesting. I don't know how recently they did that. Let me take a peek at the live news if that pops up there. Looks like it's being lumped into a lot of the WSB stuff. Tight supplies have driven up steel prices. Analysts are saying that could last a while. I think there are plenty of good reasons to be bullish on this. We see some options activity at the 28 level. We've got Rethink Steel, says Credit Suisse. Still plenty of upside. Buy rating from an analyst with a $26 price target. Honestly, when we look at news, I love looking at those analyst price targets because, like we say so often, the amount of research they're doing, that they're getting paid to do, that they're dedicating their time to doing, is far more detailed than what we could throw together as we're moving from stock to stock here on the stream. So You're seeing 26 price targets. You're seeing option activity at the 28 level. Not a bad player. I think that 20 strike is not a bad place to be come earnings. So I don't hate the idea of, getting in at that 2.01% ROR. And even if, we say 20 is a good place to be, so my eyes jumped first to the 20 strike put, but we know that we could even get away with selling a 20.5 strike put, which gives you about 0.54% greater ROR. And with that 20.5 strike getting 50 cents a premium, that means your adjusted basis or break-even price is going to be right on that 20 number that we said that we'd be comfortable with. So I love the idea of the 20.5s headed into, not this upcoming expiry, but for July 23rd, next Friday, I guess, when they're going to be reporting earnings. And then the other $1 million question, what kind of assist can your broker give you right here as far as leverage is concerned? So we know if we wanted to sell a 20 strike put, actually we'll do the 20.5 since that's what we were talking about. We know that if we wanted to sell one of those, it would be $2,050 of collateral to sell that thing fully cash secured. Take a look at TD Ameritrade. Oh boy, it only takes $245 to do that. That, my friends, is some dangerous level of margin, because we know that if we got $50, as you can see right here, divided by $2,000 of collateral, that's a 2.5% return on risk, and that's what you see pretty much right here that we have highlighted. But if you get $50 of return off of $245 of collateral, that's a 20.4% return on capital at risk. And again, anytime you see like 1 to 10 leverage like this, where normally it would be 10x to have this thing fully cash secured, you definitely want to be careful as far as position sizing is concerned, right? So if I wanted to put myself in a position where I made $500 off this, I would, sell 10 of these. That'd give me $500. While it would take up $2,500 of buying power, the important part is to, if I were assigned, how big would the position be? And the answer is $20,000 right there. So, that might be something, it's about 15-ish, 15-ish% of my account. So that would be what that number was if, shit kind of hit the fan and we were stuck taking assignment on something like that. So while it is great to use leverage like that, just always be wary of the full potential size of the position that you would be assigned. So objectively, getting a $500 return off $2,500 investment, awesome. But, that $2,500 investment could turn into $20,000 worth of shares if it drops. But again, we've got a 20 break-even price on that. They're reporting earnings. One great thing to look at here is under the Analyze tab, you pop over to earnings and we type in CLF. How have they done historically on earnings? Nothing terribly crazy, 10.8 to 11.3. We've got 7.14, pretty much, big red candle day of, right? But not a lot of movement between beginning and the end of that earnings period. Only decent move down is Q4 19, where it went from 7.6 right before earnings down to 5.73 in the few days after. But again, this middle line right here itself is the actual earnings, and that's interesting because implied volatility actually increased post earnings, where normally you see implied volatility get crushed after earnings reports, and that's a lot of what we rely on when we sell options around earnings periods. But I love the idea of getting in on CLF, especially if you could throw a little bit of leverage at it, get a smallish position that could turn into a decent sized position. Just be sure that potential decent sized position, if you are forced to take assignment, is something that your account can comfortably handle moving forward. But yeah, love the setup right there, and I think maybe you could almost get away with playing a little bit of a pre-earnings run-up here, right? I think this is something we might want to consider as well, because we know implied volatility for July 23rd is going to stay elevated, right? The earnings are going to be coming. What I think could be very useful is, like you mentioned, J March in the chat, right? They've got decent support at 21. Why not get away with just selling a 21 for this upcoming week? A very similar small buying power requirement. Would be a similar size, and then you would get away with you would be assigned shares at what, $20.80 basis, and then you could basically sell an at the money call to save your ass, and that would get you below $20 of get your basis below $20, and that's better than what we were looking at here in the first place. So I actually love the idea of turning this into one of our 10-day plays for earnings. So as we know, at the 10-day plays, what you do is you sell an at the money put. So if we wanted to follow this to the letter, we would sell 22.5 strike puts. We would sell those. We would get a phenomenal return on those, right? We'd get $730 off of $4,400 of collateral. But again, that would potentially be a much bigger position. But again, what we are paying attention to here is the ROC, return on capital, and not quite worrying about assignment yet, but assignment's a big part of the 10-day play, so you need to be able to afford to take it. But sell a 22.5 strike put. Earnings are coming up. If people get super excited about earnings and it runs up, which historically over 50% of the time is the case. So we've got some peer-reviewed research there on our side. You're going to see a run-up, or not even a run-up, but just a green week. And as we know, if we sell an at-the-money put, 22.5, a green week is enough to hit max profit right there. And even if you did sell these things fully cash secured, that's a 3.38% return. And I do want to run the numbers really quick because I did it for the next week. I want to see what it would look like for the week of right here. $730 of profit off of $44.57 of collateral. Yeah, 16.3% return. That is pretty damn good. So I love the idea of rocking with that. You know, the two-part play, the 10-day play for earnings that we always like to talk about so much. So potentially jumping in on 22.5s or even 22s if you want to get a little bit more conservative off the bat, I think is an awesome idea. Putting a big circle on that one in my notes because I love the idea of hopping into that for this upcoming week. I got a little bit of buying power, and I think that's going to be a great way to use it. The other thing, actually, that's about it. I think what we're going to look at next, Prince Meister also suggested STEM, but we're going to move from person to person to person here. We're taking turns on the stream tonight. So Jules in the YouTube chat wanted to take a look at Roku. And Roku, I mean, I got to be honest, I'll tell you off the bat, I kind of got some beef with this stock because it goes up forever and never comes back down. And you might be able to see that illustrated a little bit better if I zoom out on that. And then take the chart back to, like, I don't know, the 3-year. Where I have some very vertical analysis from sometime back in 2019 here. But maybe if we pull it back to the 1 year. This illustrates the point a little bit better, right? So Roku over the past year, low of 142, peaked at 486 back in, February? So the stock kind of 3x'd in, 1, 2, 3, 4, 5, 6, 7, 8 months for a stock this big to 3x. And Roku is pretty much the biggest streaming name other than Netflix that's out there on the market. And one where this idea of RSI is a really great way to trade this one because every time it gets decently elevated, you see some sort of significant pullback. And as you can see from the red line that I previously had drawn here, I've tried to play it back down a few times from certain levels, and sometimes it works, sometimes I've gotten burned, but I think I did get burned pretty badly on this one about a little under a year ago. So it holds a very special place in my heart for defeating me. Unfortunately. But, with that said, this thing runs up all the time. When it peaks in RSI, it usually drops back down. You can see that illustrated again right here. Jules is talking about the cup and handle. So she is thinking we see a little bit of a TA cup and handle right here. What's interesting to me is this kind of topped out back in July around this we'll call that 460. 486 was the peak of the peak back in February when this thing was running up. But a decent case for 450 to be a relatively strong level of resistance here. And with where RSI is obviously much more elevated, and I wish I kind of had my eyes on this back at the end of June because this thing was through the roof on the 1 year. But it did pull back off that. But again, it's kind of getting back up there. And one thing that I thought was kind of interesting that I've seen a couple traders do is actually kind of look at not just areas of support and resistance on the chart itself, but actually looking at areas of support and resistance on the RSI chart itself. And, there kind of seems to be a little bit of merit to it, right? Because right at the 50 level, it bounces here back in January, bounced again at the 50 level at the end of January. You see some more bounces right around this 50 level. But when it broke through the 50 RSI here back in, February, the thing really started to drop off the face of the earth. I mean, running back from almost 500 down to just under 300 at the bottom of that move towards the end of March. And again, at this 30 level where RSI officially deems something oversold, we had a couple bounces there, another bounce back in May. But, this is, I think, a good one to keep an eye on. I definitely wouldn't want to go long at this point because as we've seen with so many of these stocks that have this kind of shape for a chart, I think Zillow is one good example, right? It ran up a ton. It inevitably kind of starts trailing its way back down. But what we see with stuff like this, and shout out to Max Stacks for the follow. Always appreciate that. Feel free to keep lighting up the notification noise that we've got because I think that just means more and more followers. We've got Roku. He's saying Roku's looking sick with the bull flag. What scares me on this one a little bit with Roku is just, how quickly it's run up and how hot it's running right now. I think right here you saw a lot of that euphoria as it ran from 335 from June 16th up to 460 by June 29th. So that's a 15-day period where Roku gained, $120 on the share price, which is about a third of its value for such a large cap company. Is a huge move, and one that I think historically we don't typically see get sustained. So one right here where if I were to go any direction on Roku, I think I would like to play it short. And again, the mechanism for playing that short would be the call credit spread that we would sell, so that if this thing just did keep running, you would be hedged on the upside, so you weren't looking at some sort of unlimited loss on the short. But I think the entry point, there's also something to be said for that on this one. So I would hang tight until we start to approach this 70 level again on the 1-year RSI. Let's look at the 180 and see if it tells a little bit of a different story. Absolutely does a little bit. We're back neutral on the 180 day. I think if we start to run up here, that is when I would look to short it. But until that point, some of these stocks they run up and run up and run up, and that's all they do, and it's not a good idea to get in the way of it. If you had that kind of mentality when it was running up back in the back end of 2020, that would have gotten you hurt pretty bad. Jules is saying I sound hurt. I'm okay. Everything's good. You're just bringing back some deep memories of my former Roku call credit spreads where I got crushed playing it back down. But again, common theme with a lot of the stocks we see, especially in this area, they're starting to top out a little bit. I think S&P 500, I feel like I say it every week at this point and just keep getting stepped on by that. But I think we're due for some sort of a pullback. And when we do get pullbacks like that, one of the biggest areas that are areas that are hit the hardest are areas that have run up like this, things that have like 3x in 180 days or 3x in 1 year. Those are going to pull back a little bit more severely than the rest of the overall market. So that's why I'm always a little bit hesitant when overall markets seem to be overextended. You've got a chart set up that looks like this. There's far more risk on the downside, in my opinion, than risk on the upside if you wanted to go long on Roku here. But, speaking to that downside, if you did want to play it down, I just don't think it's in a good spot to do so yet. Wait for the test on 460, and if that coincides with another spike in RSI on the 1 year back up to 70, or if we even jump up to the 180-day chart and check the RSI and it gets up near 70 again on that number, I think that's a pretty good green light to jump in on a call credit spread and play that thing back down. That's the spiel on Roku. But yeah, one of those things where I feel like I'm normally super bearish on stuff like this, but with the setup we've got here, I think it's definitely possible. We see a little bit more of a run up in the short term, and that's why I'm holding off on doing anything until we see a run off. I say so often it's so much better to miss out on a good trade than be stuck in a bad trade. If it turns out that I'm right and it drops back down to 350, it's okay to miss out on that trade because I stood to lose a lot more if I tried to time it perfectly and it ran up through 450 on me. J-Mart's adding that the MACD turned bearish and the price is under the 9 EMA. All right, we've got someone on the bear team for Roku. I love to see it. I've got a supporter in my Roku bear attack. So I'm gonna take one more quick sip of water. I'm getting down to the end of my cup here, and then we're gonna take a look at GXGX. That was suggested by, let me scroll back up. Who suggested GXGX? It was JP in the YouTube chat. We're going to take a peek at that in just 1 second. The more I talk, the better that water tastes. So, moving forward here, GXGX. I don't want to say we've maybe talked about this one before. GX Acquisition Corp. Okay, I'm glad someone suggested a suggested a SPAC because that's definitely something that I wanted to talk about a little bit tonight. We, I guess, maybe talked about it a little bit with what was going on with IPOF and what we're trying to set up with that one. But, let's talk about it a little bit more. GX pukes. What are we saying right there, Max Stacks? But Acquisition Corp, let's take a look at the news. I'm not entirely sure what they're doing right here. What are they taking? What are they taking public here? Again, we just click through news stuff. If anyone knows anything, feel free to throw it in the chat so I don't just sit up here running through news articles on you guys. Where is GX mentioned in this article? Got some really good dead air right here as I'm reading through this. This is great for TV. Okay, there we go. Vote on the merger for Cellularity with GX Acquisition Corp. The company has a mission to lead the next evolution of cellular medicine. That sounds like quite the undertaking there, leading the evolution of cellular medicine. So typically with the lifespan of the SPAC, we know how these things play out, right? They trade at the net asset value, $10 a share. Rumors come around. The target that they plan to take public is eventually announced. There's a little bit of hype. And I think that's probably what we saw here back around December. If I had to guess, if we look between December and January on the newswire, we probably would see, there it is. January on the newswire, Cellularity and GX Acquisition Corp merged to create a publicly listed allogenic cellular therapy company. But that is what happened right there. And then all of a sudden the hype dies off with SPACs, and you're sitting right around net asset value. But what's interesting with this one, it looks like the merger potentially is upcoming. Approval of extension. Let's see what's going on. I think we just clicked on this article. Don't know exactly when the merger on this one's going to be, so it might take a second to find that. I'm not going to waste you guys' time and try to do this live on here. But what's interesting about some of these, right, is they've leveled off for so long that the premium on the calls is kind of non-existent. But if we look out to August, we do start to see a little bit of a premium again. So the way that these are priced, I mean, I would assume that the merger is this week. And why do I say that? The answer is because typically if we look at SRNG is a good example, right? This is one where the merger is not going to happen in the next week, right? So we look at the 10 strike puts, really similar chart. The thing's just been hanging out around 10 for the longest time. It's a SPAC, and you see that the 10 strike puts, despite the fact that the stock is trading at like $9.99, the 10 strike puts have just no premium on them. But when we go look at GX, these have 50 cents of premium on them, which is a lot, meaning that they expect some serious volatility. And seeing that kind of premium on a stock that has traded literally dead flat for the past 6-7 months means that something big is coming. I think that means the merger is going to be this week, and I would assume that would be why JG in the YouTube chat, or was it JP in the YouTube chat? I'm not getting this wrong. It's JP in the YouTube chat. Apologies, JP. But I imagine that's why they brought this to the forefront of attention in the chat, because we're expecting some sort of merger this week. And I don't know if there's going to be some sort of ticker change, but that's the kind of premium you're looking at, right? If you wanted to sell these fully cash secured. I mean, it's not, if this is a company you're happy with, I think anything around net asset value, at least in the short term with SPACs like this, is not the worst idea in the world, right? Because you'd get in the front door with a $9.50 break-even price, which is down here. Again, that's far below anything this thing really had been trading at, but we know before the merger, the SPAC isn't going to trade too far below net asset value. So it really wasn't within the realm of possibility that we saw $9.50. So it's, post-merger stuff like CLVR, this was formerly SAMA. We saw this thing run way up, and then they had their merger. This is $10 right here. Where's the merger? I think the merger was right around here. Actually, not entirely sure when exactly the merger on this one was, but point being, right, it broke below the $10 floor post-merger. And I think it was probably right around here is when that happened. But going back to GXGX, despite how flat this thing looks and you may be looking at the chart saying, oh, this thing hasn't traded at 950 ever, this is going to be a good idea. Post-merger on these SPACs, that's when you could start to see a break below the net asset value. And that is when you need to start potentially being a little bit concerned about downside risk on the stock. So that's what's going on with that. If you want to take that risk on, if you know a little bit about the company that they're taking public, I don't think it's a bad idea to take a flyer, especially when you consider the fact that, one, fully cash secured, you're getting a 5.54% return on risk on this one, which is a phenomenal number, annualizes to an enormous amount. You're going to make a lot of money if you can make 5% a week on a stock. And again, that comes with 70 cents of downside protection because your break-even price is going to be $9.50 a share. And, your broker's throwing you a little bit of an assist right there, too, because normally $9,500 is the amount of collateral it would take to sell 10 of those fully cash secured. But right now, it looks like it only requires $1,837. I think it might be a little easier to look at that number for one contract. But, yeah, normally it takes $950 to sell one of those fully cash secured. Your broker's only going to require $183, meaning, you're almost getting a 33% return. And again, this type of value proposition is something that almost makes me want to open a little bit of a position, right? If I can get $50 of profit off 183 of buying power, that sets up a 27% potential return in 1 week. And that's just as long as it stays above 10, right? If they merge and it goes up, or even if they merge and it stays flat, you're going to pull that 27% return, which I think is a pretty crazy number for 1 week. And one of those where, we like every now and then, if you look at our profit tracker, to get some of these premium chasing plays in there, because sometimes the payoff that we were looking at right there, like that 27% with that leverage, is just too damn good to pass up. So that might be one I put a little bit of a circle around if I can do a little bit more research on that at some point before the market opens on Monday. But it doesn't say anything about a merger, so I'm assuming the merger isn't Monday, but we'll wait and see on that. I might circle back to that and do a little bit of research. We got, Max Stacks in the Twitch chat saying CLF looks sick. 100% agree on CLF that we were just taking a peek at. I love the idea of running those, at the money cash secured puts for the upcoming week and then rolling that potentially into assignment. Well, it's either going to result in assignment or max profit. But if we don't hit max profit, I love the idea of rolling that into assignment and then taking that straight into earnings with that premium increase that we're going to see. I think that's going to put us in a great place to start that playoff. So CLF, big circle around it. GXGX, half circle around it, if that's maybe a way to circle something with less conviction. But, okay, take it back to the top. We're going back to Prinsmeister, who threw us STEM in the Twitch chat. So we've got right here, this looks a lot like a SPAC. Let's back this up a little bit further. Yeah, this definitely is a SPAC, and this scares the hell out of me. So it looks like this was initiated with a $48 price target, which I give this whole talk about how I love when you look in the news and you see some companies being given these really nice price targets. And then I'm going to probably ignore this one because what we're looking at right here, STEM, we don't know what a stock is. We pop into the fundamentals tab, we type it in, and it's going to tell us it is formerly Starpeak Energy Corp. They deliver and operate smart battery storage solutions. The company is focused on providing smart energy storage and energy management software. So it's an AI-powered analytics platform, blah, 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 blah. I feel like I'm basically doing an ad read for these guys right now. But that sounds high-level. Industrial is the sector, but what they're doing is EV batteries with some sort of AI analytic integration related. So obviously really cutting edge, interesting place to be having your money. I like that. I like the industry in the long term. But now the question, is if the price is right. And what scares the hell out of me with SPACs, and is what I was kind of alluding to when I first pulled this chart up, is the fact that we know when a SPAC goes public, right, it is essentially a blank check company full of cash where the value of that cash is worth, as we can see right here, net asset value, which is $10 a share basically. So when they take this company public, they're taking it public where $10 a share is the value of that company. So when we see a SPAC so far removed from that $10 price, it always gives me a little bit of pause, especially during this short of a time frame, right? They went public, or it looks like they had the merger, or at least the rumors back in December. and it went from 10 up to 15. And as you could see at the peak in February, this thing was up past $50 a share before falling all the way back to 16.2. But again, to the point I was making about that net asset value and the value of the company being $10 a share, at $32 a share as it stands today, what that means is what you're paying if you want to get in at this level is 3.2x the value of the entire company as it stood back on the merger, which was less than half a year ago. So is that typically a good value? I lean towards saying no. I don't think it's ever a good idea to be paying, I mean, with very rare exceptions, no company does enough in the span of 3, 4, 5, 6 months to be worth 3x their value, 4, 5, 6 months prior. And that's exactly what we're seeing right here. And that's exactly what's represented by jumping in on this company at this level. And it's up to this level because of the industry it's in. Super sexy, attractive industry, getting into EVs and battery powered stuff like that. But, so many stocks out there that we don't need to get in on one if we feel like the valuation is a little bit too rich. And this gives me, Vietnam-like flashbacks to Hyliion, which we're going to have to back up a little bit further on this one, right? Was a SPAC trading at this level. It's in the electric vehicle space. Super cool. Initial spike. Again, broke 50, similar to STEM. And then had this catastrophic downfall, which we got caught up in because we just got a little bit greedy at the time, but now we know better, and hopefully we made that mistake. We say this all the time. Hopefully we made that mistake so you guys don't have to. But what I see in the Hyliion chart and the way that that's set up, similar deal. It's a SPAC, EV industry, big run up just off hype and being in the industry, and then inevitably fell back down. And it even broke decently below that 10 net asset value, bottoming out at 769. So if you look at STEM, it's almost like we're in the first phase of that, right? You see this initial spike. It did recover a little bit off of 17, but I think 32 is way too rich of a valuation to be getting in at. What this thing does have going for it, though, decent option decent option volume. So, there's going to be a little bit of liquidity if you're trying to hop in a trade here. And you've got weekly options, right? So many of these options that we look at only have monthly, so there's not a lot of flexibility in how you can manage those plays. But with what we see on this one, we've got weekly options, which is really nice. There's flexibility on a week-to-week basis of what we can get. And there's some really, really nice RORs. And again, when Hyliion was on its descent and had reached the $30 level, this is the similar kind of stuff that you were seeing. And it was so tempting to go back to these on a week-to-week basis because pulling 2% a week while you could go $2 out of the money on something like this looks really, really nice. You're not going to be able to protect your downside too well if this thing falls back down to this low 20s level. So one of these where sometimes the conclusion we come to on stocks like this is, hey, throw it on your watch list, get a target price for it. I think the best target price on this one is going to be, let's see what the 180 day looks like. Looks like there's decent support right here at 24, here at 22, 22, 22 again. I like the idea of waiting for this thing to drop to 20 a share before you start getting ideas of jumping back into that. So I'm putting STEM with the $20 price target. There we go. We're going to call that our official internal HT research right there. So $20 price target for entry. And while that is 2x of, what the valuation of the company was upon the merger, it's a lot better than paying 3.2x. And it's going to be a lot more manageable in terms of where you're going to be able to get your break-even price as far as, option selling and management of that basis is concerned. One thing we can do if you are the person who says, I really don't think it wants to get back down to 20, but I do want a position in it, is to go a little bit further, maybe a month or 2 months out, and sell a 20 strike put. Let's see what kind of premium you can get on something like that. There you go. You can get it's not great. You can get a 1.01, look like 1.52% return, which isn't really that great. Max Stacks asking about ATOS. That's an interesting one too. We've been looking at that a lot over the past few weeks. Had a couple plays on it that made us some money, but I'll add ATOS to the list and we'll circle back to that one in just a second. So good question on that. But going out of here, maybe one advantage sometimes that you get going out a month or so is that you get a little bit better option buying privileges, right? So normally this would be a $19,000 position, but they only require $3,900. But it just doesn't look like it's worth it. especially when you're getting this kind of premium up top. Decent, I mean, not insane premium out of the money on the call side. Just something I don't think is the greatest value in terms of what we're going for with our strategy, right? We always want to be wary of that downside. Again, yeah, awesome, Prinzmeister. Thanks for throwing it in the chat, because again, this is one I've never heard of, but now it's on my list. It's got that $20 price target, so if it gets back down there, we're going to be perfectly happy because we've done our research tonight. We know what's going on in general with that one. We might revisit it again before, finally pulling the trigger, but it's a good one to know that, hey, this is something within the realm of possibility that could come up and is now on our radar to potentially jump into at some point in the future. But, the more things like this that you get on your watch list, that you get on your radar moving forward, the easier it is to be patient. If I have 1 or 2 stocks on my watch list, that's a little bit oversimplified. Let's say I have a watch list of 10 stocks, and they all have like a price target that's 30% below what they're trading at. I'm going to get really antsy and say, okay, I'm just going to buy one of these, and it might not be the best value. I might be impatient when I'm doing that. But if you've got a watch list of, 30, 40, 50 stocks and that you've got price targets for entry on, it gets a lot easier, because not only out of a population of 50 are you more likely to have something hit your price target than a population of 10. There's a lot more going on that you could pay attention to on that population of 50, so you're not dead set on this, little 10 stock watch list. And that's something that we're looking to offer at some point here in the near future too. We talk so much about the HT premium we're thinking about rolling out, but having the watch list that we keep alluding to full of price targets and up-to-date news for the ticker and up-to-date prices for the ticker and alerts when things do reach price targets is something we're also looking at offering, because I think that would be very, very helpful. But STEM is not a circle for this week, not an X on it either, but throw it on the watch list. We'll wait a second and we'll get back to it. We're gonna take a look at Apple stock now, courtesy of Jules. AAPL. Shout out to Jules in the YouTube chat if you're even still if you're still bearing with us on this. We're coming up on the 2-hour mark. I think we're hitting a record in length for the stream right now. And I have all sorts of lines on this one that I'm going to just remove because they look ridiculous. Let me just get rid of this drawing. Okay, cool. So what happened here, and I think this is really funny because we had someone in our Discord server who was long on Apple and I think sold 135 or 140 strike calls, which, fundamentally was the correct move to do, because I think they did so when it was trading around this level and said, hey, if this thing runs up to 135, I'll be thrilled with the gain. But, since then, Apple has made this just unbelievable move up from 125 back in June to 145 in the span of a month, which is, historically, if you back up the chart on this thing, spot the red candle, I guess, on this on this run upwards. It's insane what we have been seeing from Apple over this past month, and RSI is definitely catching wind of what's been going on there. It is as high as it has ever been. Maybe not ever. It might be. It's pretty much equal with what was going on last August. But again, we love RSI because it gives us a pretty good indicator, at least in the short term, next week, 2 weeks, about what we could expect from the price of a stock. And here, I think we potentially could see a little bit of steam get blown off. This is a really, really smooth ramp with almost exclusively green candles on the way up here from $125 to 145. So this is a little bit choppier, so it's tough to compare these one-to-one. But this was the last time it got elevated. Let's see what's going on in the 3-year. Maybe get a little bit. Okay, so now we're just getting elevated right here. Again, this thing, when you look at what happened back in 2020, which is what we were looking at on the 1-year chart right there, where RSI was elevated, it's higher than what we're seeing on the 3-year RSI. But typically 3-year RSI isn't that useful. So I think, a year out is as far as you should go. So we'll go back to that 1-year look. Max Stack's asking about Apple puts. So with what we do, and I'll explain, because a lot of people, stumble onto the streams, are new to following us. We don't ever buy puts, right? Because if you want to look at an Apple put, let's say you bought a 145 put that expired in a couple weeks, right? what would have to happen is it would have to drop $2.6, right? Which is like 2%. And it would have to drop 2% just for you to break even, which is not the greatest value proposition in the world. So what we do is if we want to play a stock up, right, we'll sell the puts so we get a little bit of a cushion on our trade. But if we think the stock's going to go down, I think the best way to short a stock is going to be through a call credit spread. What's tough here, though, is I think Apple's at an all-time high. So we can't really look to the past too much to find, okay, where do we think resistance is going to be? That is something where we could, I curse TA, and, a trading channel doesn't even look too feasible right here because it's gotten a little bit sloppy on the back end of this move. So I might stay away from doing something like that. But, I think the move here definitely is not to go long on Apple, because as we can see, RSI indicates this is not a great place to be in. And that's not to say I wouldn't go long on Apple, period. I think Apple is an awesome stock that probably is just going to continue to go up because fundamentally speaking, from a business perspective, they are just printing money. So, I mean, they're one of the most fundamentally sound businesses out there. So always a good investment to have Apple in the portfolio. But if you're looking at entering into a play, I just don't think all-time high with RSI through the roof is going to be the way to do it. I think it's going to pull back at least a little bit in the near future. And if you wanted to play that with like a 150 call credit spread, we throw a vertical on there and take a look at this Friday. I mean, you could get a decent, what are we seeing right here? It's not that good. It's not that good. 220 max profit off a 2280 max loss. If you want to get a little crazier and go closer to the money, that might be a little bit of a better value prop where you're pulling 280 max profit off 720 max loss, 33% return on capital. But, you'd have to keep it below 147, which, that line on the chart looks like nothing in the face of how big this move has been. So, and typically I think, better judgment would suggest to me that it's not necessarily the best idea to short stocks that are incredibly strong like this. And it's not to say if you short it, you won't be right. But, we like to play the numbers games here. Apple has gone up pretty much since conception. I don't want to get in the way of that. So that's something maybe I'll put on the do not short list. But at the same time, I don't think the entry is quite right for a long, which, isn't much of a conclusion. I think maybe if you were, Jules, if you were asking that in the context of, I know you're a lot more into some of the TA stuff, but if you thought there was some sort of bullish breakout coming up here, I don't know if I would initiate a position because I think RSI is what scares me off more than anything here, suggesting it's going to be pulling back a little bit. I think you could definitely swing a 140 entry at some point in the near future, but yeah, not one personally. And again, I'm not a registered financial advisor, so this is all for educational purposes and things that I personally would do. But, personally speaking, I would hang tight until about this 140 level here because we saw a similar peak back in January. And that was when RSI, glanced off of 70. It wasn't near as elevated as it was right now. And even when it glanced off of 70 in the RSI land, it went from 144 back down to 130. So I think there's definitely some tangible downside in the near future on that. So you'll be able to find a much better entry point if you were looking for some sort of a bullish entry. So I'm throwing the X through that one. That's a stay away for this week. We've really only got time for one or two more, and I say that because we're coming up over the 2-hour mark, and it is getting a little late over here. So we're gonna do. What are we going to do? We're going to do APT and ATOS. Yeah, totally agree with that conclusion right there, Max Stacks. So, and appreciate you jumping into the stream tonight, Max Stacks. I always love it when new people are showing up in the chat, throwing stocks in there, and, along for the ride with the analysis that we're got going. So first we're going to look at is APT. They're a mask manufacturer, Alpha Protech. Huge red candle if we zoom in right here in the last 10 days. Yeah, it looks like we dropped from 832 down to 720. What's going on with this right here is it's a little bit, this was kind of a COVID play. Shout out to the Bearded Bull for the follow. Welcome. Again, love hearing that notification noise. But what's going on with this one, APT, is it's a mask manufacturer. So this was a really big COVID play, and you could see that, right? It spiked up, back in February of this year. Let's go back 3 years. There you go. This is how you could tell something is really a COVID play. It was trading at, 320, 330, $4 a share for forever. And then all of a sudden COVID hits, and then come February, March of 2020, the fateful months, this thing peaked up to 41.59. So, I mean, it is since retracted. The demand for masks obviously is never going to be as high as it was back then. So this is one where I think the use of the products of the company is kind of on the way out. So, the future outlook isn't looking that great. And that's just not something I don't know if that's one I would want to be in for the longer term. What's interesting here, I guess, if you're looking at it from a TA perspective, is the initial bounce they had back in January. It bounced up to this, 6 or 7 area. So maybe we could see that as support. Taking a look at the 180-day RSI, where we bounced off of oversold territory back at 715. It's previously been in that oversold territory back in the beginning of May. But, I think if you're trying to bank on a short-term rebound, maybe not the worst thing in the world. I seem to recall volume on these was pretty low. Yeah, there's like no volume. Excuse me, that's for the spreads. Not a ton of volume to rip off a trade. And that's for something that's trading at like, a midpoint of 14 cents, 15 cents. This is some pretty big spread right here. So that's something where when you're trading options and trying to sell options that are, between 8 and 22 cents, getting screwed by even just a couple cents on the fill price on the option you're trying to sell just really isn't, it can be very impactful. We're looking at APT for Matthew Ellis, who's asking in the YouTube chat. This is Alpha Pro Tech. This was suggested in the chat by one of the viewers, and it is a mask manufacturer. But yeah, I think long story short here, premium isn't enormous. I mean, if you could manage to get a midpoint fill at 15 cents. We know that if you sold a 7-strike put for 15 cents, your break-even price would be 685. I mean, not a bad place to be, 685 for a break-even right here. So that may not be the worst value in the world if we back this up to the 20-day. Yeah, again, you got to zoom out to see that red line that we drew. He was looking at Prinsmeister saying he was looking at January 2022 options. Is Prinsmeister paying more attention to the chat than me? Let's see. Maybe. We'll take a look at the January options. So let's hop over to the trade tab. See what premiums are looking like on that. And they're just... if you're really trying to play some sort of a pop, I don't know what the catalyst for that would be if some sort of Delta variant news regarding COVID comes out. There's the upside is definitely there, right? Because you would think even on the back end of 2020 coming into 2021, that's back when the vaccines had been produced, the light at the end of the tunnel, or so to speak, was kind of showing up for COVID. Yet we still saw some sort of jump from 11 up to 20. Let's take a peek at the newswire real quick to see if we can see what was going on back around January, February. Let's see. Biden to order mask wearing on federal property. Okay, so we had some government involvement where, the White House was saying, okay, we need to have mandated mask wearing. Fauci recommended 2 masks. All this, pro-mask news was coming out. So that is what caused that spike up. And if maybe something that would be a decent, kind of weird to say here, but if there were some sort of second COVID wave related downturn in the market, this almost seems like it wouldn't be the worst hedge in the world, because even if it reverts back up to this $10 level, and you've got plenty of time to wait if you got in on January, Prinsmeister, you're saying the Lambda variant, we're already down to Lambda variants. Good Lord. That is several variants. Maybe I should get some of these calls. But as we know with break-even prices, right, when we go long on options, I don't think selling a put's going to be the way to go here, because you'd be stuck with if you wanted to sell a 7-strike put, you're pulling a 23% return in 5 or 6 months, which again, objectively, if that worked, is good. However, I'm not confident this thing is going to be staying above 7 come January. So this is, the downtrend since February is pretty clear. So I'm not sure that's something I'd want to be, hanging my hat on at that 7 level. I know the break-even price would be just under 6 a share. I don't think that's anywhere near enough of a cushion over the next 5 or 6 months for something that's pulling back like this. But if you wanted to go long on some of these options, maybe like an 8-strike call, where you could jump in for about $1, your break-even price would be 9, right? So it would have to jump up. I mean, never great, obviously, when you need something to move up just to break even, but that's how long options work, and we stay away from those. But sometimes they're a better value prop than what we could see on the sell side, and what we saw on the selling side wasn't great. So we're gonna take a look at the buying side. But yeah, you'd have a 9 break even price, but if something crazy happened, you see another jump back up to 25, up to 20, or even up to like 14. Just to double your money on these, you would only need to jump back up to the $10 level. So if it spikes back up to 10 here at some point and you purchase those, I mean, there's definitely decent upside there. However, the further something drops, the more it needs to rebound to get up there from a percentage perspective, right? So just for it to get it back up to 10 from 729, that's going to be a 271 drop divided by 7.29. The current price means the stock itself needs to go up 37% just for those for those calls to double, right? And you would need to get up to 9 just to break even. So 9 from the current price of 729 is going to be a 171 increase in price of the stock divided by 729 current price means that just for you to break even on those January calls, you would need APT to go up 23.4%. I don't think that's great value either way there. I think that's just a good one to leave alone for now. If any news comes out that, changes the trajectory of the stock, it might be a good one to revisit. But for now, COVID, while they say in a literal sense it's going to be something like the flu where, the bug itself is always going to kind of be out there. I think the economic impact and, the economic benefit that the mask industry saw, it doesn't really stand to benefit too much from here on out. So that one I would stay away from. And then last one of the night, we are going to look at one more. We are coming up on the 2-hour mark on this stream. So for those of you who have been hanging on with us and watching along and chatting along, always, we really appreciate that. But we're going to wrap this up looking at ATOS, Atossa Therapeutics. This is I think this is a great one where, sometimes the conclusion that we have is to throw something on the watch list with a price target. I think this fits the bill pretty well for that one, right? Because if we always want to start big and then maybe kind of zoom in. Yeah, actually, I say the opposite sometimes. We want to start small and zoom in, right? If we look at the 1-month trading chart, this thing's run from 4 to 9.8 to 5.34, but then you want to back up a little bit, right? Because you might say, but just from looking at the 1-month chart that, okay, so my downside is roughly, the 450 level right here. But if we back this thing off a little bit, we could take a peek at the 180-day chart. We know that, 4 really isn't the downside that we thought it is, right? It looks like there's a little bit more support at the 320 level. We've got a little bit going on at 250. A lot stronger support at the 2 level, as we can see right here. You see 1 base right here, 2, and then it, kind of stalled in that level for a bit. So I think 2 is a really solid base on that. As Max mentioned right there, the Twitch chat, it did bounce off 5 short term. It does scare us a little bit, though, because when we, at least in the context of the strategy that we're looking at with selling options, we, let's see right here. Context of what we're doing, if we take a look at the option chain, the trade tab, that's the word I was looking for. Great RORs, right? However, you're not seeing, the spreads are kind of, there. It's a 5-cent spread. It's not that bad. But what you're seeing right here, indicated by this yellow number up top, is the implied move on the week. So based off the price of these options right here, there's an implied move of $1.20 either to the upside or downside. So one good way to look at that is, based on the way these options are priced, we expect a 120 move either to the upside or downside. So upside would be 530 plus a $1.20, give you 650. Downside would be 530 minus 120 to give you 410. 410 that is? Yeah. And that is what that looks like, right? So while this is the line that we drew for support at the $2 level, based on the way these options are priced, going back to the trade tab, they imply a move of $1.20 this week, which is a pretty damn big move for a stock that's trading at $5.34. So the idea is if you wanted to sell options on this, you would want to go outside of the legs of the implied move in order to mathematically have the best chance at profit on this. So what would that mean, right? So we know our low leg. I wouldn't want to get involved in anything on the call side. Definitely wouldn't want to go short calls on something with, the potential for upwards movement like this. But on the downside right here, right, we've got this line drawn at about 420. That's the downside, meaning we would want to sell 4 puts. But when we look to 4 puts, there's really not any premium on it. If you're able to get 7 cents on it, you're able to get 1.91% ROR. Max is saying peep the OI on weekly calls. I did read about this a little bit. There is a huge number of open interest on weekly calls, so a lot of people are thinking that we could see a huge some sort of gamma squeeze here. But important to notice, they're added 12 strikes, so we'd have to get up to that area to see anything in that realm of possibility. And the fact that there aren't a lot of premiums listed on the 7.5, 9, or 10 calls is a little bit telling. And Max, I'm glad you asked that question in the Twitch chat, saying you're confused as to what we do, because a lot of what we do is a little bit new to a lot of people who are used to either trading stocks or options, right? So our strategies that we do revolve around selling options as opposed to buying options, right? So for example, if you were someone who was going to buy a 4.5 strike put for 20 cents because you thought ATOS was going to go down, we know that if you bought that put, your break-even price is 420, meaning you would need this thing to drop all the way to 420 just for you to break even, which is not that great, right? The thing could drop 20% and you still wouldn't make even any money. You would bet on it to go down with the 4.5 strike put. It could drop 20% and you still don't make money. That's a terrible deal, right? Because you could be right, incredibly right, about the direction of the stock movement and lose money. So what we do is we sell options, right? So if you thought the stock was going to go up, what we would do is we would sell that 4.5 strike put. So if the stock goes up, this expires worthless. We keep the 20 to 25 bucks that we get off that 4.5 strike put that we sell. If you're new to option selling or new to any of the strategies that we're talking about, I think our YouTube channel is a very, very good place to start if you want to pop into the main strategy that we develop and teach is the HT wheel strategy. And we've got 4 videos. It's a whole little series we've got on our YouTube channel that explains it. But one of those things where I've tried so many different types of trading in my experience in the market. Option buying, I've done crypto, I've done penny stocks, I've done regular buy and hold, I've tried swing trades. This option selling strategy that we are using is the single best strategy I've found in the stock market. As you can see with our year-to-date summary, it is severely outperforming the market. We're killing it so far on a week-to-week basis. We haven't lost money over a single month. And yes, we do have Twitter. We do have Discord. We are at Hourglass Trader on Twitter. And I think we've got links to our Discord and YouTube channel embedded into our Twitch channel. Matthew Ellis on the YouTube side asking, are we a fan of Tasty Trade's similar strategy? I'm absolutely a fan of Tasty Trade. They are really great at throwing together some, beginner videos and throwing around concepts and things like that. And I think they're really helpful. The strategy that they use is super, super similar to what we do. I think what we do, they would maybe consider a little bit aggressive, but conversely, I think I would call what they're doing overly conservative. But yeah, we are definitely on the same wavelength as Tasty Trade with what we are doing as far as their option selling is concerned. So if that was a resource you'd been using, it's a great place to be. But yeah, we've got Twitter, we've got YouTube, we've got a Discord. That is feel free to pop in, ask questions anytime. We call out all of our trades in the Discord server. So if you want to search for that, that's where you can find them. But anyways, yeah, ATOS, we know that the implied move is $1.20 both ways. So the way that these options are priced is suggesting it's going to stay within $6.50 roughly and $4.20. So if we wanted to sell an option for the upcoming week, it would need to be outside of those in order to mathematically, again, it's a numbers game that we're playing, mathematically put ourselves in a position to profit here. Another great question, are you a group of people? The answer is no, it's just me. I am one person. Although sometimes I say we. I don't know why. But I'll just pretend I'm referring to the community when I say we. We could roll with that. But yeah, it is just me. I am one person, Hourglass Trader. However, ATOS, if we did want to sell these, outside the implied move, which is what we would want to do to mathematically make some cash in the long run, would have to come at the 4 strike on the put side if you wanted to go bullish on it. But it's just between 5 and 10 cents a premium. If you're able to snag a fill at 10 cents a premium, that's really Prinzmeister saying the royal we. I like that. If you're able to snag a fill on a 4 put for 10 cents a premium, I like the value right there. If you throw the let me throw the calc up here again on the screen to show you what that return will be looking like. If you wanted to get 10 cents, which would be $10 return off $400 of collateral, that's a 2.5% return on a weekly basis. What do we know about 2.5% returns on a weekly basis? If we pop over to our little annualization calculator again, here's our website. If we go to tools, annualization calculator, and if in 1 week we make a 2.5% return, and Jules saying that I have multiple personalities, maybe that is an equally valid explanation to casually dropping the we. But we know that if we make a 2.5% return, let me blow that up a little bit so people can see it. A 2.5% return is 262% a year. So a lot of the time people come over from option buying backgrounds and say, hey, a 2.5% return in a week, this is terrible. I've been buying options. I'm aiming for a 50% return or a 100% return in a week. That's just not a smart trading approach in the long run. And, it's so easy to get sucked in on social media to people who say things like, oh, I made 100% this week. I made 200% this week. We turned $1,000 into $5,000. And while I'm not saying that they didn't do that, and shout out Max Stacks, appreciate the follow on the different socials. And again, I'm not saying those people didn't do what they're claiming to do, but I think the logical question to ask those people is, what does your account look like long term? And I think more often than not, when you see people who are flaunting those big gains and are chasing 100 or 200% a week on option buying, those people are not making money in the long run. A very, very small percentage of people who buy options make money in the long run, and they have far more tools, far more experience, and far more knowledge than the retail trader is going to be able to get to. So they have an edge that, quite frankly, is just not realistic for the average trader to get to. So that's where the option selling strategies come in, right? A super low percentage of people make money buying options. And what does that mean? It means they're losing money. So who do they lose money to? They lose money to the people who sell them the options, and that's us. We sell the options. So again, we're targeting a 2.5% return right here, or we're saying the play that we were just looking at would be a 2.5% return if you're able to get a 10-cent fill on the 4-strike put. That's a 2.5% return, to which the point that I was making is if you're someone who's from an option buying background, you might look at that and say, oh, what do you mean? Like max profit is 2.5% a week, but max profit is it's very likely that ATOS stays above $4 a share in the next 5 days. That's the idea, right? So point being is that this is a 2.5% return, but it's a high probability 2.5% return. And if you're able to get that high probability 2.5% return every single week over the course of the year, you're going to return 262% over the course of the year. And even if you start with $3,000 or something like that, or how about this, $2,000, you're a millionaire in 5 years if you're getting 2.5% a week. So, I mean, first thing I'll tell you is you're not going to get 2.5% a week. If you did, you would be rich. Now, it's something we could aim for because, as you could see, if we sold that ATOS 4-strike put, we can get 2.5%. We could aim for that. Now, the idea is it's going to happen a lot. It's not going to happen all the time, right? So you're not going to get 2.5% every single week and, turn $2,000 into $1 million in 5 years. That's just not going to happen. So get that out of your head. But what we can do is aim for 2.5%. So if we execute the trade the way we want and it works out the way that we want, we're on this path. But at the same time, we do that with the understanding that, hey, we're not going to hit all these. Sometimes we are going to lose some money on this. That's okay. It happens. But in aggregate, if we open up more plays that keep making 2.5, those are going to cover up the losers, like we took a look at with our trade performance, right? We've got a 90% win rate. We've got some losers that are buried in there. But more than canceled out by the amount of winners and that huge win rate that we've got going. And like you're saying, yeah, max stacks in the Twitch chat. So if you sell an option for $1 and buy it back at 1 cent, and the best part about this is you don't even need to buy the option back. You can let it expire worthless, and you won't even need to worry about that. And that's what we call max profit. So yeah, to answer that other question, we do disclose account balance. We show all that in here. We try to be very, very transparent about everything we do, every single trade that we make that you see in our weekly tracker. This is currently our portfolio on a week-to-week basis. Everything you see in here was called out in our Discord server. So everything you see here, what you see is what you get. Super, super transparent as we can be. We've got a lot of winning weeks. You get to see the bad weeks just as much as you get to see the good weeks. Max Stacks wants to make max profit. I love to see it. Come join us. You'll be hitting the max profits on a conservative and consistent and smart basis. Though we're not going for 1,000% returns in a year in a week. But this is what we do. We're gonna slowly build the account up. We're gonna get small, consistent, high percentage gains, and we're gonna slowly just grind up and to the right throughout the year. And while sometimes this can seem like a little bit of a slow grind, for example, earlier in the stream we're talking about how we had a $6,000 loss a couple weeks ago that we're still working back. I mean, we're still up 68% on the year, and we're halfway through. So while sometimes this can seem like a slow slog upwards, we are still miles ahead of the S&P 500, and that's really our goal right here, to outperform the market. So, with that said, ATOS 4-strike put, if you can get a 10-cent fill on that, that's a 2.5% ROR on the week. That's what we're looking at. But that is going to be the last thing we look at tonight. That's our year-to-date summary. This is what we're holding on for this upcoming week. And one of the best ways that I like to look at, how good of a position are we in on a week-to-week basis is how much premium are we going to collect on these stocks if they don't move at all, if they stay perfectly flat. So even if they don't move our way, but if they also don't move against us, I think, evaluating stocks as if they trade flat is a good way to do that. How much money are we going to make? And here is the answer. This will expire worthless. This will expire worthless. This will expire worthless. This will be worthless. This will be worthless. These are August expiries, so we won't touch these. But this will be worthless, this will be worthless, this will be worthless, and this will be worthless. So all the stocks that we have plays on right now, if they don't move a single cent, I mean, hell, they could move for us and we still would get these numbers. But if they don't move a single cent, we're going to be making about $3,000 this upcoming week. That's just under 2%. So that's exactly right in the wheelhouse that we like to be at, right? We're targeting this 2%, 3% at max profit. And again, these are just the plays that we have at the beginning of the week. So many things happen throughout the week. Like we mentioned, there's only so much research you could do on a Sunday night. Oh, and the other thing I forgot to mention, if this doesn't move, there we go. $3,700 is what we're going to be making if none of the stocks that we're playing move a single cent. So that's a great place that we like to be heading into the week. And again, this is just what we have at the beginning of the week. So much happens during the trading week where, we might have only held all of I think we really only held down to here heading into last week, and we opened all of these last week. So much happens during the week. The plan that you have coming into Monday can be completely out the window, even just 15 minutes into the trading day. So that's why it's always important. This is where I kind of give the spiel for the Discord, where we're always in there communicating with each other, letting everyone know what's going on with the market. If things are changing, we're calling out what we see. We're giving alerts to our trades, so when we're entering, when we're exiting. You don't even have to do much work if you want to just kind of follow along. But, that's what we've got set up. This is what we got going into the week, and that is where I'm going to cut the stream off. I think this is a record stream for us. We're a little over 2 hours, but always fun to be going this long when the ideas are kind of flowing like this, and we've got some good stuff headed into the upcoming week. So always happy. I think hopefully it was equally helpful for you as it was for me to kind of have some of these names be thrown back and forth. Shout out to people who are new followers. Shout out to people who are new to the chat. Always appreciate having you guys on with the stream. But we are going to sign off the way that we do in all of our videos, saying this has been the Hourglass Trader, where as time passes, we make money. Let's have an awesome, awesome week. To quickly answer one more question, we stream every Sunday night at about 9 o'clock Eastern. This week I got a little bit more free time, so I might do a little Tuesday or Wednesday night stream to talk about, focus a little bit more on earnings plays that we might have coming up. But again, thank you guys so much to you guys who've been tuning in week out, who are active in the Discord and communicating with us, because it helps me just as much as I hope it helps you guys. So thank you guys so much for tuning in, and we'll talk to you again either in a few days or in a week. So thank you all so much, and have a great and profitable week.